morning, everyone. Yeah, I'm going to do the big picture stuff this morning. I just want to say thank you to the London Venture Capital Network team and sponsors for having me here today. I've got 30 odd slides, which is quite a lot. So I'm going to go through them very quickly. Some of them are quite text heavy. We will share a link afterwards if you want to go and revisit any of the data or the, pick holes in my arguments and things as we go. So I'll just go through them as quick as I can. Quick word on what the BVCA is. So it's the British Private Equity and Venture Capital Association. We are over 40 years old. We are the industry body and public policy advocate for private capital. So that's our sort of catch-all term for private equity, venture capital, but effectively, GP, LP funds, so include private credit, venture debt funds, and others within that. And we have training, sort of technical policy leads and things like that. So, we are usually, government-facing, making the case for venture capital, wider private capital sector, how we can do more to support it, get more investment, get, back more founders and things like that. So that's largely what we do. We have about 600 members, actually, given that we're in this room, and when I came in, I thought, this doesn't feel very venture, but actually, venture capital, private equity now is very much part of the mainstream, hence why we're in a sort of grand old city building. When I first started working in venture capital events sort of 10 years ago, it was sort of, basement in Shoreditch somewhere, all of it sort of exposed concrete and, that kind of thing. But now, look, it's really come to, play such a larger part in the role of the economy and the, the conversations we have around growth and things like that. So, as a combined industry, I'll go more into the venture capital data itself shortly after this. It's 7% of UK GDP. It's spread, not just in London, as we always think. 60% of 9% of the jobs provided by our industry are outside of London. Very strong returns over the last decade. Up and down over the years. But if you look at a long horizon basis, very strong. 2.5 million people are employed, and you can see the sort of regional breakdown there. 8% of the total jobs, and again, more bang on about how great our returns are. So that's private capital and what the BVCA represents, and as I said, now very much part of the mainstream. We produce various reports. You can see who from my design team designed these slides and which ones I did, because these ones have QR codes and all look very fancy. And as I said, we'll share these. You can find these reports online. So our latest one was venture capital in the UK, which sort of deep dive into the data I showed you before, specifically around venture capital. I'll come to them as those slides shortly. We've done a lot of work on unlocking pension investment. We've partnered with the other pension trade associations on an expert panel over the last couple of years, following Mansion House, and we've got a report sort of how we can unlock that capital to actually invest in venture funds, and I'll come to that later on as well. And then we have diversity and our various political events throughout the year. So that's BVCA. So now moving on to the UK VC market. I mean, we said at the start sort of global and UK, but I'll largely focus on UK, but then sort of consider it in the global context. So from our latest venture capital in the UK report. So when I'm talking about this data, and I'll use other data sources which I'll refer to throughout, but our BVCA data, it's sort of slightly smaller than the others, but it's purer, I like to think, because we get all of the data from our members on returns, the investments that went well and not so well. So, there's probably more in depth than those that are available purely reliant on public sources. So if we're thinking about, so when I say venture capital, we mean the LPGP funds. In the UK, so not angel investment and everything else. 9 billion deployed last year. That was up. Holding periods going up as well. I mean, that's true of private equity and venture capital. I mean, it's on average 6.7 years, but as we know, venture model, it's either very long or very short, depending on how well the company goes. But that's that as you would expect in, we've had a bit of a downturn, that those time horizons to increase. As I said, it is a very well-established industry now in the UK. Still comparatively small compared to private equity and others, but in terms of the growth agenda and everything else, it's increasingly important. And then if we think about VC fundraising itself, and I'll come back to some of the conclusions that we can draw from this at the end. VC, so our members, as I said, we've got about 100 VC funds in the membership, so everyone from index ventures all the way down to sort of solo GP funds and everything in between. Invested about 9 billion, as I said. They raised, so we think about funds closed in 2024. They raised about £4 billion, so that's up 1.7 billion on the previous year. As I said, it's been a tough few years, so at least that's back on the way up in terms of funds closed and VCs raising more money, which is good. We are seeing, and you're seeing this in the US as well, and maybe this is a sort of sign of that trend in the UK, that you're getting that bifurcation between very large funds. So as I said, a big portion of that increase that we see between 2023 and 24 in terms of VC fundraising, a lot of that was probably one or two funds. One of them was Index, raising very large, and a large proportion of certainly of that increase and of the total raised. But the actual number of funds is also increasing. It's went down over a couple of years, but now that's back on the way up. And we're seeing more, sort of smaller funds, solo GPs, specialist funds raising. So you are starting to see that, sort of bifurcation between very large funds and more sort of emerging smaller funds raising as well. And you can see the breakdown there. And I was quite surprised. I would have expected family offices to have been a larger contributor to this, but as you said, it's an interesting breakdown of where UK VC funds raise their money. Pensions, for example, and I'll come back to this later on. It's 8% of the total, over 300 million, but that's all overseas pension funds. Now that's some UK pension funds. The 6% you can see down the bottom there. Government agencies, that's largely the British Business Bank, which is the largest single LP in UK venture funds, fund of funds and others. You would expect to see them taking up quite a large portion of this. So in terms of general trends, it's back on the way up from when I did this talk last year, which is good. That's good to see. As I said, but it's interesting to see. If you go down to it a bit more, you'll see where the money's actually being raised and in what sort of proportion. So UK jobs data, as I said, over 50% outside London, which is good. But you do see that. You can see the proportion of companies, almost 5,000 in London compared to 439 venture-backed companies in Scotland, 137 in Northern Ireland. So it is, in terms of the actual companies, employees, it is still, there are national and regional discrepancies across the UK. And we've seen some growth in some regions like the Northwest. But others are still sort of more nascent ecosystems and still growing. Move on to the next one. Because we are part of the European Data Collective, we have sort of our sector breakdown is quite broad. I'll come to more. There'll be some more sort of deep dive into the sort of where we're actually seeing the venture capital funds deploying their money. But their information and communication, things like that, they do sound slightly old-fashioned, I guess. But as I said, because we have to track this all across Europe, we have that. But yeah, so you'll see the levels of investment there. But as I said, on the way up compared to previous year. Areas like deep tech, this is actually deal room data, which we've nicked for this one. 20% year-on-year growth, and a lot of that's driven by defence. When I think this was now a different data set a couple of years back in 2022, I think UK VCs invested 15 million in defence, and 2023 it was 300 million, and I think we're expecting that to probably double again and continue to go up given the prevailing global climate. So deep tech, defence tech, we're expecting that's going to be a real big growth area in the UK and obviously across Europe for obvious reasons. Now sort of turning back to, what are the UK VC market strengths? As I said, some of the numbers there show that it's, VC fundraising, VC investment is back on the way up after the sort of boom in 2021 and then a sort of down market. So that is largely positive. UK government always like to say, and you get a variation on this theme every year, bigger than France, Germany and Sweden combined. And then I think it's important to note that at early stages, so when we think about pre-seed, seed and Series A, this is British Business Bank data, largely equivalent on a GDP basis with the US, which is really good. And we'll come to the later rounds later on. So I think that, we have a lot to be very proud of on how UK venture capital has grown certainly over the last 20 years following the dot-com crash, which people still refer to. But I think it is a very well established. You've got funds that are very well established, raised 4 or 5 funds, increasing in size, great returns generated over the last 20 years. So and there are other countries look to us and say, how can we emulate what we do? So I think we should never be too down on ourselves, although that's what I'm about to do. So the not so good. As I said, so if we think about the later stage, the sort of Series B plus deals, then that's when the US sort of pulls ahead on a GDP basis. And I'll come to the sort of, you'll see that in the average round sizes between the UK and the US, which I'll come to later on. And exits I'll come to as well, because the exit market has been really, it's still very down, even though fundraising's up. Keep waiting for market conditions to improve before we get those big exits. VC is, it's where the exception is the rule. You have the power law, it's the big exits that really drive the returns in venture. Private equity is much more sort of slow and steady. You get a sort of more consistent returns profile, whereas in venture, it's, the top quartile drives the returns in terms of venture. So we're still sort of waiting for some of those to come through, following the sort of, when the market was at its high point in 2021. And this is, so if we think about 4 billion raised, 9 billion deployed, the actual exits last year was 700 million. So as I said, there is that discrepancy between the levels of exits we're seeing at the moment and where they're going to. So obviously, IPOs are only a very small number. I think, and none of those last year really were the really big IPOs which drive a lot of the returns. It's mainly trade sales, write-offs. I mean, some of the lower end exits will either be write-offs and will probably be spread across there. But yeah, we're seeing a lot more sales to corporates, private equity are definitely on the way up, and other types of exit market remain closed. So, but in 2021, the exits was double the amount raised. So it does, they kind of, they go up and down alongside each other. But we're still waiting for that exit market to really pick up at the moment. So looking at deals. So when we're thinking about where, how many deals are being made. This is Bohurst data. So this is a broader data set which includes angel investment. You can see that whilst 2021 was obviously, the sort of the height of the market, if you consider it as a general trend from 2015, it's still broadly going up. But you would expect, given the hype of the market in 2021, that it would come down, and it's still relatively robust just in terms of deals. There's the number of deals and the total amount raised is still holding up pretty well, and not as a sharp drop as we've seen in other countries. Sector, again, these are all looking down as well, but you can see the sort of general trends coming through that as well. Some of them are very steady, obviously. Areas like fintech, it's come down, but we'll look at the total investment. There are, emerging sectors here and more mature sectors, which are fewer deals, more money. Other, software is always going to be up there. Whether AI, kind of overtakes that, just in terms, whether AI eats software, I guess is something we'll see play out. We're not seeing that in the data quite yet. As I said, if you actually break it down by sector, this is deal room data. So sorry, I'm moving around between data providers, but just to help tell the story. Fintech, as I said, it was probably fifth or sixth in terms of the total deals, but is still, and has been consistently over the years, the number one in terms of money deployed, or money invested in those sectors. And you'll see, some of the more emerging sectors coming through there as well, which is good. So coming back to the point I made around, where the UK, the sort of scale-up issue that we have, if you actually look at the round sizes, so this is British Business Bank, did an analysis of this, you can see that the UK compared to the US, we start, just over 50% on average compared to the US, and then that, gets even larger, and then it's more than double by the time you get to round 6. I mean, we don't, the sort of grey areas between seed and Series A, so I think they've just gone for the round size, which are the actual round sizes themselves. So that's where, there is a lot of capital in the UK, but it's not as concentrated in the rounds themselves, and that's why the US, is usually such a leader in this, because they have not just more capital to deploy, but they invest it in larger. They're more willing to deploy it in larger rounds and get sort of that scale going much faster than we do in the UK. So that's something we need to work on. And then in terms of the capital efficiency itself, so this is unicorns per 1,000 companies. This is BVB data again. You'll see the UK is actually behind France and Germany in terms of the actual number of investments we make and the unicorns created, and the US is far ahead, and actually India's really come up that list recently, and China are way ahead. So that's another area where the UK, as I said, very strong at the early stage, but actually converting that into, I mean, not everyone likes the term unicorn, but turning it into those later stage large companies that's where we do struggle. And I don't know if this is ever reflect. If they could look at this in their data, but you're just going to see how many of those UK companies actually, list in the US or become a unicorn in the US. That would be another interesting thing to see. But yeah, so that's where another area where the UK struggles a bit and could do better. So as I said, so BVCA, we work on. We are the policy advocates. How do we improve the market for the UK venture capital, but also tech and the tech scene and the founders that they invest in. So I'll go over these very quickly. So as I said earlier, the British Business Bank is the largest LP investor in UK funds. I think there's more we can do to kind of make the British Business Bank be a supporter from the very early stages all the way through the venture capital ecosystem. There are sort of gaps and things which, if you go into our report, you can see and how we improve that and how we get more new players, emerging funds into the industry. The British Business Bank is a very important part of that. We have huge, the sort of UK research base, I can't remember how it is, 5 of the top 20 universities in the UK, in the world, sorry. We have a really strong university research ecosystem in the UK. Getting more investor readiness, getting more of those spin-outs, more of those companies coming through the ecosystem is a really important thing. There's been a spin-outs review a couple of years ago. There's been really good movement on that. So, we're just asking government to really double down on that and getting more of those companies into the pipeline of venture capital to create, national global winners. I won't go into R&D tax credits. I know some people can talk about that for a long time, but just making sure that works better and more efficiently will do for now, as well as the enterprise management incentive regime, which is a very important tax regime to keep talent, retain talent in UK tech companies. If any of you have any questions about any of those, do come and find me afterwards. And obviously we do have in the UK the very successful EIS and VCT schemes. Which recently copied by France. They've introduced their own version of EIS. So this is giving individuals tax breaks to invest in companies or angels to invest in companies. And we also have EIS and VCT funds, which get retail investors to invest through funds to invest in companies. And they have been renewed, which is good, and because they have 10-year horizons on the schemes themselves. They've been given another 10 years, so they'll be keep going till 2035. And at the moment, we're sort of talking through increasing some of the limits, which haven't gone up in 10 years. So we're talking to the government about that at the moment. So there's some really good things to build on there that we're talking to the government about at the moment. Pensions has been a big area. You've probably heard about Mansion House. This is going to be transformational for UK tech, for UK venture, and more recently the Mansion House Accord. 10% of our, which is basically said, 10% of the default, so the growing area of UK pension funds, which are defined contribution pension funds, going into private markets by 2030. It was doubling what was in the original Mansion House announcement a couple of years ago, which all sounds great and very much needed, given where UK pension funds are, in order to increase people's pension pots, diversify away from where they are at the moment, take a bit more risk, get involved in private markets, and get access to those returns, which other countries, we've had speakers from Canada, Australia coming in because they invest here. So they invest in the UK and they say, in Canada we don't have a very developed venture capital private equity industry, so we invest here. Why don't you guys do the same? So that's, I think that's really good signaling. We're not seeing the money trickle down to venture quite yet, which I'll come to. I'm not sure it's on, but I think it might be on another slide, which is that, so last year, UK pension funds invested 0%, as I said earlier, in UK venture funds. So, and that's hovered between 0 and 1% for the last 4 or 5 years. So there's a lot of work to do there. BVCA is sort of leading on that. And actually this year, because this is all 2024 data, we have seen 3 UK pension funds invest in UK VC funds. Small amounts, but something. So we're starting to see the whole messaging and intention behind Mansion House translating to investment in venture funds. Only a small amount so far, but we'll take it, and we should build on that, and it's something the government's very keen to do. But they also want them to invest in infrastructure and public markets and everything else. But in terms of our world and venture, it's still central to those developments, so we want to keep that going. The report that I mentioned earlier, I think in order to really catalyse the investment in VC and tech from UK pension funds, we have a very, we came up with, working with the pensions industry itself, some recommendations to government to really sort of turbocharge that process, because it does take time. You know, these are huge pension funds. It takes them a while to kind of build up the expertise to do this, so the government can play a helping hand effectively. So we've got what we call the Nova scheme, which is, you know, this time we've copied France, which is a way for the government to play the sort of middleman and get, you know, the matching up the pension funds and the VC funds and various vehicles through the British Business Bank, just to help, you know, create the funnels to get that investment into venture capital, into tech, and try and address some of those kind of gaps in the financing, which I mentioned earlier. So again, if you go into the report, you can see more on that. From a, you know, purely, you know, from more of the technical, you know, tax, legal, regulatory points, you know, what the BVCA does and what we try to create, as I said, for the ecosystem, is to make the UK the best place to raise a fund, deploy capital in the UK, sorry, in the world. So, you know, to sort of build on our role as a venture capital hub, you know, and carried interest, you know, when the current government were in opposition, had some pretty strong wording about it a few years ago, that they would effectively abolish the tax treatment which VC funds and private equity funds receive for the, you know, when they generate oversized returns, and we engaged with them very heavily. We had a Partners for Growth campaign, and you know, the tax went up, but it wasn't abolished entirely, and we got a pretty good outcome there. Still a lot of detail to work through, but I won't go on about it too much. And then there are, I definitely won't go into the regulation because I don't want to bore you too much, but there are also the FCA. We're now meeting, you know, regulators used to be a closed shop in the UK. You know, we never used to go into the FCA or the CMA and, you know, they would just sort of say, these are the rules and, you know, we'll talk to you about them once we've published them, and then that's it. But now, with the government sort of, you know, wanting to reform the regulators, they're coming to us. My boss is now sitting on one of the innovation boards at the CMA. The FCA are really engaging with us on all this. How do we make the UK a better place to, you know, and to create and set up and invest from venture capital and private equity. So yeah, and there's, you know, they're launching a consultation at the moment, which is all about making the UK, because in venture capital, I'm sure many of you are aware, you know, there are, you know, so many UK VC funds, but they're either Channel Islands, the funds themselves, they're Luxembourg, they're US. There are very few actual UK funds, even though the teams are here. So it's a bit of a, you know, trying to address that and making sure that you can be a UK fund and have the team here. It would make things a lot easier, I think. So if we can get that right, that will be another good win for the industry, and make your lives a lot easier, I hope. And finally, diversity. I mentioned the report earlier. You know, ventures, you know, better than private equity in that regard, I think. Still a lot of work to do. I remember when I worked with a managing partner from a VC firm, and we did a survey of all the other chairs of investment committees at VC funds. We talked to about 50 4 years ago, and we didn't speak to another woman. It was just her. So we spoke to 49 men about how they run their investment committees. So it sort of showed, you know, even 4 or 5 years ago, the level of women at the actual decision-making levels of ventures was very low. We're seeing, you know, the more junior roles, there's more women now, 31%. That's come up quite a bit in the last few years, which is good. But then when you get to actual investment committees, as I said, 16%. Again, that's up, but a hell of a lot more work to do. Ethnic diversity is also improving. And there are, you know, you might have heard of Social Mobility Ventures and others who are looking at, you know, the backgrounds of venture capital funds. 5 minutes. All right, I will skip ahead then very quickly. Investigating Women Task Force, government-backed fund to invest in, women-only teams, which is really positive. Okay, that's perfect timing. This is when I wanted to go to in 5 minutes to go, so that's I've completely fluked that. So I think there has been a lot of, in our world anyway, articles about, you know, the venture model itself. As I said earlier, you know, the sort of, you know, the struggles there have been with exits, the IPO market being shut, etc. You know, is the sort of classic LPGP, you know, sort of 10-year, 12-year horizon where you back something at pre-seed, try and get it to IPO and make a big return, and everyone gets carried interest, everyone's very happy. You know, does that need to, is that, you know, is that time horizon being pushed further and further? Is that model really working? Do we need to evolve? Do we need to get more creative in that regard? So, you know, you'll see, I saw this a few weeks ago on LinkedIn, venture capital is dead, long live private equity. This is reflecting what's going on in the US, that, which I'll come to. And I saw various AI-generated versions of Guillermo's post on LinkedIn, generated a lot of coverage. And this is being driven a lot by what's going on in the US. So Lightspeed, they're moving to, you know, moving away from the LPGP model. They're becoming a registered investment advisor, which people are saying is a new model. It's not. It's just a new way they can invest. So they can invest more like a private equity fund. They can do more secondaries. They can do roll-ups. They can sort of build rather than just investing in classic VC rounds. They're going to investing in other ways. Andreessen's similar, and other the big US VCs are becoming listed funds. More permanent capital vehicles. So again, moving away from that. I think a lot of them still do have LPGP funds, especially at the early stage, but certainly at the later stages, given that the IPO market has been so difficult, they're thinking, well, why don't we just keep companies private for longer? So is that a trend we'll see here? Given what happens in the US, usually translate, we'll see. Obviously, there are new models in terms of, AI is having a big effect, not just, firstly on, how VC funds will run themselves, but now it's actually, getting involved in the deal process. So the founders of Revolut come up with Quantum Light. They raised $250 million in the last week or so, and basically removing the human element from choosing their investments. And we'll see how that works. And there are similar funds in the US who, use their sourcing, use their investment decisions, with AI. So that's something that's emerging as well. And then, as I sort of referred to earlier, we're not seeing that here so much yet, but in the US, the new entrants there is at the lowest level I think it has been for the last 10 years. So sort of new funds coming through are finding it really hard, and the investment in venture is more going towards those larger established funds. So whether that will happen here. So as I was saying, issues with existing VC model, exits are increasingly difficult. Fundraising is taking longer. So I've met 2 VC funds in the last week who both just raised. One of them was 3.5 years. They put a 1-year horizon on it. It took them 3.5. He looked very, very tired, but it was, he got there in the end, which a lot of people have been really struggling with. But just, the fundraising and the number of investors he had to go and speak to was, I think it was 600. I think he spoke to in order to get, what was a relatively small fund raised, and I'm sure others people have spoken to a lot more than that. And then, as I said, the sort of squeezed middle. So you're certainly seeing that in the US. Maybe our data from last year reflects this, that you're seeing either mega funds or really specialized solo GPs, smaller funds, and then maybe the more sort of Series A funds in the middle are getting squeezed. I'm not saying that is what will happen or what is happening, but it is a trend which people are noticing in the US and potentially here. And then there's also the amount of founders graduating from seed to Series A and then Series B and beyond has been going down in recent years, and there have been various campaigns sort of looking at that. I think only 8% of founders who've raised seed over the last couple of years have actually moved on to raise a Series A. So they're either giving up or just still waiting. It's been much more difficult. So again, is that do we need other forms of capital for these founders rather than just venture? So yeah, okay. And what needs to change? I've got just 1 more minute. I'll get into that. So more venture debt, more growth lending, more corporate venture capital. The UK is way behind the US in terms of its venture debt. Corporate venture, as I said, venture debt, growth lending can bridge rounds, can be a lot more creative in how it deploys. Exit routes, secondaries, private equity is much more creative at how it gets exits than venture is. So we are seeing more secondary transactions in venture, which is great. Need more of that. More M&A, obviously what's going on in the public market reforms you've probably heard about in the UK, so we've got more of that as well. More capital, pension funds, raising more money from emerging markets as well. The UK's been very reliant on the US and Europe, so getting out there and building up your LP base, as well as the domestic, we want to see more capital come from domestic sources. And lower barriers to entry, like I said, making it easier to set up a fund in the UK, raise capital. I think we have a real opportunity now. I've also met in the last few weeks several US VCs come here saying, my country's gone insane. I've come to the UK because I speak the same language, and I want to know about how to raise a fund. How much does it cost to raise a fund? That's insane. So it's like it's good getting their experience of raising funds in the US compared to the UK and understanding how much it is 20, 30 times more costs to set up a fund in the UK than it is in the US. So learning from the US and how we make that easier and lower the barriers to entry. So I did put questions on here, but I think I'm out of time. So if you want to ask questions, do come and find me afterwards. I hope that was interesting. Thank you.